Good afternoon, everyone, and good morning in some cases. And thanks to all of you for joining us for today's webinar on microloan underwriting. I apologize that we're getting started 5 minutes late. Our webinar provider's been having issues with their phone lines. So we are challenged on that front, but hopefully things are working now. What I'd like to ask folks to do is we need folks, and Lavi, if you could chat this out please to everyone. Because the phone lines are not working for folks, the only way to access the webinar at present is to do it by listening to your audio through your computer speakers. And I'll come back to that again in a sec, but just so folks are aware of that. So I'm Joyce Klein. I'm the Director of the Field Program at the Aspen Institute, and we're really pleased to be able to offer this webinar today with two practitioners who have developed some really strong expertise in this area of microloan underwriting. And I'm going to introduce them to you and turn you over to them and after just a couple of technology-related remarks and some other introductory remarks. And I'm getting a note that folks are seeing hearing an echo, and I also want to tell my team here we're still not. Let me just see if I can get our. Oh, great, our slides are up. So we're getting forward, and again, folks, just apologies for some of the technology issues. So as I mentioned, we hopefully all of you folks are hearing us, and you're doing that because you're accessing it through your speakers on your computer. Again, if you just make sure you get good viewing, good hearing quality, hopefully. You can turn your speakers up as loud as they go if there's a problem for you there. If just so you know, if accessing through the computer is not any worse than accessing through the phone, we had a really strong response to the webinar. We have almost 190 folks joining us already today, and we had, I know, probably a couple hundred or so more who have RSVP'd. That doesn't mean, just because you're on the phone doesn't mean you can't communicate with us, and we want you to do so. We hope you'll feel free to make comments and ask questions along the way. So what we encourage you to do is to locate the chat box on the left-hand side of your screen, and you can use that to share comments or questions with us. Your messages only come to the presenters, so don't feel shy about volunteering an answer or sharing a comment. We've set aside time throughout the session at which time we'll be going through the questions and comments and responding to them. We also have a couple of times where we have polls where we'll ask you to respond to a poll question to make it a little more interactive. And again, here your answers will be anonymous. We just see the totals. We don't see who said what. So please also note you can view the presentation in full screen by clicking on the full screen icon on the technology. The one thing you should know, if you want to send us a question or a comment, you have to exit full screen to get to the chat box. So another thing I wanted to share is when we do webinars, we get lots of requests for the copies of the slides. So you should know you already actually have them. A PDF of the slides was attached to the confirmation emails that we sent you. And the PDF has also been posted to our event page on the Aspen Institute website. So that Aspen Institute is www.aspeninstitute.org. You can look through the events for today, and if you click on that sort of tile for the event page, the slides are also there. So, and we are recording this webinar, hopefully, assuming the technology is working. And if that's the case, we can also post that to our website after the call. So, also just so you know, if you haven't seen it in the chat box, if you have technical issues, and we're doing the best we can, apologize if you're having issues, you can send us a message via the chat window to the members of our team. And their email addresses are also in the PDF of the slides that we sent you. So what I'd like to do just briefly, for those of you who may not know the field program at Aspen, just give you a little bit of background on us. Our mission is to advance business ownership as an economic opportunity strategy. We actually are part of the Economic Opportunities Program at the Aspen Institute, and the work of that program is to advance promising strategies, policies, and practices that help low and moderate income Americans to connect to and thrive in our economy. And Field's the part of that work that focuses on the role that business ownership can play in advancing opportunity. To do that, we focus on strengthening the work of practitioners who are working on the ground to meet the needs of low and moderate income entrepreneurs. And we do that in a couple of ways. We try to build knowledge about the field through applied research and data collection, and we often work really closely with practitioners to be able to do that. We support leaders through peer learning groups and leadership development programs. And we also work to inform donors and to support donors invested in the field by providing them with research, information, and analysis. And a good deal of the work we've been doing in the more than 2 decades that we've been around has focused on documenting and sharing leading practices. Another core of our work is focused on developing metrics and collecting data that can be a tool both for strengthening practice by allowing practitioners to benchmark their work over time and relative to others in the field, but also data that demonstrates the value of the work that practitioners do. And funders and members of the media who want to understand microenterprise in the U.S. come to us for our data. And the reason we're doing this webinar today is to advance both of those goals. First, we want to share information about leading practice in microloan underwriting, which we think is a key issue facing the field. We could tell this was a topic where there was a lot of demand for information, and the response we've received clearly demonstrates that. And second, through this incentive, we hope to provide incentive for you to report data to our ongoing U.S. microenterprise census, and I'll talk more about that at the end of the webinar. But for now, let's talk about microloan underwriting. For this webinar, we're focused on microloans, which means we're focused on the practice of underwriting business loans that are less than $50,000 and are loans to individuals who fit the typical target market of microenterprise organizations. So that's women, people of color, low and moderate income individuals, and others who can't access loans elsewhere. And underwriting microloans is different from underwriting other kinds of business or commercial loans, and we wanted to share the specific practices that apply here. And so to do that, we've invited 2 individuals who have a depth of experience in this area, and we've had the privilege of knowing them and their work for many years. Both of them, Leslie Hoffman and Barbara Eckblad, have built and managed lending teams at CDFIs, Leslie with a New Mexico-based CDFI and Barbara with one in Wisconsin. Both currently lead their own consulting firms. Leslie works in community development and Barbara's with CDFIs, and they also work together as well. Leslie also teaches at the University of New Mexico's Anderson School of Business, and as you can see, Barbara's background includes owning her own business and also working in the banking industry. And so they're really well qualified, and we're really pleased to have them offer this content on our behalf. So what I'm going to do now is turn it over to Leslie to get into our content. Leslie?
Great. Joyce, thank you so much. First and foremost, Barbara and I would be so remiss if we didn't start with an enormous thank you to so many people who are on this call, and Joyce, to you as well. What we're going to share with you today, guys, is really a reflection of things that we've learned from our years, both as practitioners as well as consultants, from a lot of really, really great people in this industry. So we want to thank you for that opportunity. And we thank you so much for the chance to talk about something that we really love to talk about, and that's underwriting. You know, from our perspective, this is really part of the essential heartbeat of our industry. It's where we like to say the community development rubber hits the proverbial financial institution road. So, and we know that this is a topic of great interest. As Joyce said, the response to this webinar we're certainly really excited about, I think demonstrates, we know, team, that you all right now are experiencing a lot within your CDFIs microfinance institutions. You know, there's a lot of opportunity. I think there's also a lot of angst around market and reach and scale. So we think that this is a really important concept for us to take some time to talk about as you all experience those various shifts within your own work. So today's journey is going to take us through a number of concepts actually. We're going to explore risk and repayment. We're going to really dig into predictors of repayment. And I'm excited for you all to hear about what Barbara has to share with you there. And we're going to use a very familiar framework in that conversation. Our goal is this. We hope that you're able to walk away with at least one of the following. So think about this as you listen in what we talk about moving forward. We hope you have a new idea to share with your team out of what we talk about today, or maybe a new way to look at an old idea that helps you meet your mission. maybe it's an idea for a topic you and your team need to dig into further or revisit. And I'm sure we'll hear from you during our 2 Q&A sessions about things that you may disagree with or you may want to learn more about. Either way, we're excited for you to chat into that chat feature and ask us that question. Now, let me take a minute to talk about what we're not going to have the time to dig into today. Underwriting, as you know, is a really big topic. And so here are some things that we're not going to have the chance to get into today. So Joyce, if you want to move to that slide. Unfortunately, guys, we're not going to have the chance to do really deep work on cash flow analysis, for example. This isn't going to be a how to build spreads, for example, for a microloan. This isn't going to be about lien perfection, loan packaging. There's a lot of things that touch on or technical skills on underwriting that we know are really important. And fortunately, we're all headed to OFN next week, at least a lot of us are, and so there's some great sessions there for you to dig into. There will also be contact information at the end of these slides so that you guys can let us know if there's something more you would like to learn about. So with that, I want to start with a pulse check with the group. I'd love to get a sense of where each of you is entering this conversation. So if you go to the next slide, we want you to think about this. If you had to boil underwriting down into a single concept, what would that concept be? And you've got some options on your screen. So there you go. There's your question. If you had to boil underwriting down to a single concept, which among these would you choose? Information verification, technical assistance for clients, risk management, financial analysis. Take a minute and just think about it, and then hit submit. All right, we've got some responses coming in. Great. Well, so a lot of good answers. And here's what we want to emphasize, going back to the slide deck. The reality is that actually underwriting touches on all of those things. But the organizing principle that we really want to highlight and elevate for you all today is the idea of risk management. It's the organizing principle that touches on mission fulfillment, touches on technical assistance, touches on financial analysis. And you all as underwriters, you all are the guardians at the gate for both your clients and for your organization around risk. Your job is to help determine what's the appropriate risk. So there you go. We've got a lot of folks who are on the risk management bus, 66%, which is great. And again, I want to emphasize, if you felt strongly about financial analysis or any of the other answers, that's not a wrong answer. What I'd encourage you to do, though, again, is think about risk management as the kind of core operating principle under which all of these other pieces and tools fit. Okay? Now, as we think about risk, something that I want to highlight as we get into this conversation, if we go to the next slide, is that the truth of the matter is when we're talking about risk management, credit risk gets a whole lot of attention. It's sort of the popular girl at the proverbial homecoming dance. And you know what? There are other dance partners on that floor of risk. We've got market risk. We have operational risk. We have liquidity risk. Our encouragement to you today is to think holistically across all of these facets of the organization. Really, think of it as a chessboard. And each of you as underwriters are master chess players. So when you move one piece on your credit chess, one piece on the credit risk game board, you really influence the entire picture. And it's one of the reasons that why underwriting is one of the things that Barbara and I really like to talk about the most. So let's talk about credit risk. Let's get into that conversation in the next slide. When we talk about credit risk, there are 2 levels that we're talking about. We're talking about credit risk at the individual level, and we're talking about credit risk at the portfolio level. It's kind of micro and macro, if you will. Both are really important. Both, again, as the visual shows, are really intertwined and interconnected. One drives the other. Today, our focus is really about the individual part of this equation. We invite you to join us in October as we get into a conversation about that larger portfolio part of this conversation. But for now, our call to action for you today is to listen to the content, think about your own shop, and whether within your current underwriting approaches, your approach fits these characteristics that you see on your screen. Is your approach systematic? Is it evidence-based? Is it transparent? And is it monitored? We would argue from what we've learned and what we've been taught by so many of you on this phone, by Joyce, by Elaine, by others, is that you know that you are moving in the right direction if you can say these things about your approach to underwriting individual files. It's a way to ensure that what you're providing is mission-focused and mission-consistent. Now, let me take a pause here. And I have a feeling I can hear some of the, perhaps I can climb into your heads a bit because remember, I was you. And I know that one of the things that you all may be thinking, moving to the next slide, is, wait a minute, Leslie, you live in fairyland called Consultantville now, and I appreciate all these great words you got on this slide. However, in my day-to-day, I experience this kind of push and pull. And so if we go to the next slide, it gets us into that conversation. We understand fully, particularly as you all are experiencing growth and wanting to grow with quality, that there is this kind of yin and yang experience between the relational components of our work and the transactional components of our work. In fact, I'm curious. Let's go to the next slide and put up the audience poll. In fact, I want to know, how often do you experience tension in your lending team between these two elements of underwriting? I want you to take a minute. I really want you to think about this. How often do you, in your role, and you may not be an underwriter, that's okay, but we'll make it more broad. If you're not an underwriter, how often do you, just in your job experience, in your lending team, experience these relational and transactional elements of your work? Does that never happen? Does it occasionally? Frequently? Maybe even daily? I'm curious to see where folks are in this experience. Because as we tally those results, let me say this. In my practitioner days, there could have been an email that I just got before getting on this webinar trying to help balance that dynamic tension between the transactional and relational elements of our lending practice and our underwriting. So for me, for Barbara, it was a daily and sometimes hourly experience. And in fact, I want to lift up field research here. Joyce and her team through the Scale Academy have done some great research around understanding what microfinance organizations go through as they scale. And in fact, what that research finds is that microfinance organizations as they scale tend to go from maybe a more heavily relational model to a bit of a balance between the relational and transactional. So we understand that this is what you are, this is the dynamic tension that you're experiencing. To help resolve that dynamic tension, and let's look at the results and then go to the next slide, Barbara is going to offer you a new way to look at an old framework or model. Because our answer to you, team, in the way you really honor the both and of the relational and transactional elements of our work is to use a framework that helps you remember those 4 words, helps you ensure that you're being systematic, evidence-based, transparent, and monitoring what you're doing in underwriting. And it's the good old 5 Cs. So we remember the 5
Okay,
Cs. Yeah, go ahead, Joyce.
Yeah, sorry. I'm going to go ahead and put up the next slide. And I just want to quickly break in. We're getting some feedback. I hope it's not too pervasive that some of the audio for those of you who are listening over your computers is cutting in and out a bit. I'm not sure what the problem is. We're not hearing that, or there's a little bit of an echo. So I'm not sure what the problem is. Again, please bear with us. Hopefully, if the recording is not clear, we may just re-record it when we can get the technology to work well. But in any case, we'll do our best to get you as clear a recording as we can. So thanks for your patience. Go ahead.
Sure. Thanks,
Barbara.
Joyce. Thanks. So as we headed over to Barbara, we've got this 5C framework. And remember, these are factors that help us understand our borrower's financial capacity to take on a loan, capital resources, the balance sheet, the environment, and what assets are available. Now Barbara is going to talk about the most essential elements of this model for microlending and how you can build or sustain that systematic, evidence-based model that is both transparent and can be monitored over time. So Barbara?
Thanks, Leslie. Good afternoon, everyone. It's just a privilege to be with you. And I second Leslie's thank you to you, too, for all that you've taught us over the years. There are many of you on the call who have taught us a lot about what we're sharing with you today. So think of us as the conduit through which you're learning a bunch of things, hopefully today, that come from the much broader community of microlenders that do this work every day in our country. So when we're approaching underwriting for microloans, we're really trying to establish that level of risk that we're taking on as an organization when we're giving other people our capital. So in other words, we're really looking at the likelihood that we're going to get repaid. And what we'd like to do is to frame this for you in the following phrase. We're looking for the predictors of repayment of our capital. So as we look at those 5 traditional C's of credit, character, capacity, capital, conditions, collateral, we're looking for what in those 5 C's are the predictors of repayment narrowly construed to microlending underwriting. So what I'd like to do is I'd like to take a pause. Joyce, can we go to the next slide, please? I'd like to take a pause, and I'd like to ask you if it's a combination of the 2 C's of character and conditions, of character and capacity and capital, or of conditions and collateral. I'd like you to vote on which of those 2, which combination encapsulates the 2 C's that really are about predictors of repayment. So go ahead and vote. And feel free, if you're with a team of people who are listening, to talk amongst yourselves about this. Okay. Well, Joyce, would you like to go to the next screen? The answer is yes. The answer is character and capacity. And your poll shows that you are almost all spot on about this. So that we're looking at the 2 predictors of repayment are character and capacity. So when we approach that credit file, these are the 2 C's that we need to analyze because they're going to accurately measure how likely we are to get repaid. As important, though, as the fact that these are the 2 C's is how we define character and how we don't define character, and also how we know how we are accurately measuring capacity. So I'd like to start with exploring how we measure character objectively when we analyze our risk. So Joyce, there you go. So as a predictor of repayment, Leslie and I would like to offer to you this definition. The character C is the borrower's history of repaying debt and or their pattern of behavior when they're managing their financial obligations. Let me say it again. We're looking at their history of repaying debt and or managing their financial obligations. So do you see how narrowly we're defining that character C? We really aren't addressing that broader definition of character that we often talk about, which is the client being on time for our appointments, for example, or they have their paperwork well organized, or they look good, or they sound good, and they have a great business plan, and all of their projections are super tight. Yes. Are these important? Of course they're important. But they're not predictors of repayment when we're underwriting the loan. They're really helpful to us as we look at that client and we're assessing their challenges and skills in running their business and running it efficiently and effectively. But they don't tie directly to the ability of the client to repay their loan. You can go to the next slide, Joyce, please. So where do you find that transparent, evidence-based information that you need to figure this out? So some of this is information some of you already use, but there's a whole range of folks on this call, and some are learning to underwrite microloans, and some are using some alternative tools. And all of this is balancing act. But what we really are trying to emphasize today is that we're not balancing behavior against objective facts. We're really looking for a third-party objective piece of information or set of information that we can determine help us to know that there's a predictor of repayment there. So those of you in small and emerging organizations or using alternative tools, we want you to know that we feel these are the key tools that we need to be objective and transparent about assessing that risk. We all know that traditional financial institutions, banks, credit unions, as well as our CDFIs and microfinance institutions, we all really look first and foremost right to that credit score, to the credit score. And what we'd like to say is that all of us know that that credit score is really too narrow a lens to look at when we're looking for a history of repayment on the borrower's part. So we know from experience that lots of our borrowers come to us with large medical bills from a medical event, and also other significant events that have interrupted what is otherwise a clear history of repaying their debt. So in these situations, we need to look behind the medical bills and behind the major interruption to be able to see if there was a prior pattern of repayment of debt. Likewise, we have clients who come to us who have a low credit score because they have very few lines of credit that get reported through the credit agencies, or we have clients who come to us who have absolutely no credit score. What do we do with them? Well, we typically look for what we call those alternative sources of credit for them so that we can establish that they manage their financial obligations. Those look like cell phone bills, for example, rent payments, or utility bills. This gives us an alternative way to establish that people are that our potential credit borrowers managing their financial obligations. So we're trying to figure out if a borrower with an adverse credit of history has a prior history of repaying their debt before this financial interruption. So we also look for objective evidence that the borrower has reestablished that pattern moving away from that event. Has that prospective borrower reestablished their pattern of meeting those financial obligations? In a credit report, we know that this shows up basically in where they have payment plans on their liens and they're making those payments on a regular basis. We also want to verify that the client at the same time has reestablished the stability of their life that caused that significant event. So for example, if the disrupting event was because our borrower lost their job, we want to see that they now have a new and steady source of income. So it's important to see that objective evidence that the borrower is moving away from that incident that interrupted their ability to pay on their debt and is reestablishing that pattern. So let's talk a little bit here about bankruptcy. So bankruptcy is a big deal, and we really need to respect the incredible impact that has in our borrower's life. At a minimum, you're going to want to see objective evidence that that borrower has reestablished their repayment of their debt and that the underlying cause of that bankruptcy has been resolved or stabilized in their life. And we really recommend that you want to see that pattern of repayment for at least 18 months before you're willing to risk your capital. Okay, now we also work with clients who, no matter how deep we dig, no matter how hard we work at it, we really just do not have any evidence that they've been able to manage debt as we see it through their credit report. So what do we do with those clients? I really like to call those clients not yet clients, because what we want to do and what we typically do in our industry is we refer them to a resource so they can start to build their skills through financial literacy and training and get to the point where they can manage their personal budget and make payments on a regular basis. And as they're successful at those strategies and build that capacity to repay debt, they can come back to us and be reconsidered for a small loan for their business. So in summary, we're really narrowly construing the character C in this predictor of repayment as a history of repaying debt and or meeting financial obligations. So we'd like to encourage you to think about how you do this and to see if that underwriting risk that as you work with character is aligned to these concepts. Okay, let's talk about an example. Joyce, would you like to go to the next slide, please? I'd like to introduce you to Chanel the plumber. By the way, my plumber is a woman and she's a rock star. She has 6 men working for her and they all clean up before they leave, which I love. So Chanel, she's a 30-something who grew up as in a plumbing family. She has a college degree and she's working in the private sector right now. And she's only recently realized that part of the reason she doesn't like her job is because she just really wants to be a plumber like her dad. So her father's getting near retirement and she wants to take over his business. She needs to replace his old van and she needs to get her plumbing license, which is not inexpensive. As she was growing up, her dad's business successfully supported her family, but he hasn't spent a lot of time building the business and it's begun to shrink as he started to cut back. By the way, Chanel is also now a single mom and she has 2 small children. You really like Chanel. When you meet with her, you really like her. She's always running late though, and she's always struggling to bring the right documents when she does show up. Her business plan she promises you is almost done, but she's really struggling with those projections because she really doesn't know how quickly she can build the business based on her dad's old reputation, if you will. Your experience with her is that she's scattered, and she's harried most of the time, and honestly, she's a little sleep deprived. So here's your challenge. Chanel has a 550 credit score because of the illness of one of her daughters. That illness has buried her in medical debt, and her current job doesn't provide her health insurance. So recently she qualified for insurance under the ACA, and she's stabilized her financial life. Prior to her child becoming ill, she actually never missed a payment, as you can see on her credit report. And she has never missed a payment, including her student loans, which are a really heavy burden for her given her income. So when you talk with her about those challenges, one of the things it's clear to you is that she's really clear about that burden. She's embarrassed about it. She's working hard to figure it out, and she's got all of those medical bills on a payment plan. And since they've been on the plan, she hasn't missed a payment. So, by the way, Chanel has 1 credit card that she shared with you that she doesn't use. The limit on it is $750, and she keeps it in the drawer at home. The reason she has it is because she needs a safety valve if her car stops working and she needs to get it fixed, because she knows that her car is really important for her so she can get to work. You perceive her as super eager to work with you, and she takes your recommendations as she's working on this new business plan. You also know from talking with her that she has a pretty broad family support system that's helped her through her divorce and her daughter's illness. So she, in a very lovely way, has talked about how supportive her dad is of her taking over the business, because he teases her that he wants to work for her. So there's Chanel the plumber. Leslie?
Okay, so Joyce, I'm going to have you help us out here. So now we've got a question for you. You've heard about Chanel's story, and you've also heard about Barbara's explanation of character and how we're encouraging you to approach character. So now you see a question on your screen, or you'll see a question on your screen momentarily. Give this some thought. What's a positive indicator of credit history for Chanel? Feel free to chat in your answer in the chat box, and Joyce will call out some of the answers as you chat them in. But think about Chanel's story. What's one positive piece of credit history that you've heard about our 550 credit score borrower.
Okay. So are you ready for me to start reading, Leslie?
Yep. Go for it. And Barbara and I will both react.
Okay. Did not miss a payment before the medical incident. Followed medical payment plans. Credit card not used. No late payment. Current on-time payment of the restructured medical bills. Student loans. The repayment of her debt, especially with a focus on her student loan debt. She's on payment plans and she's never missed any of those payments. She pays all her bills in full and on time. Just looking to see if there's anything else. Consistent repayment, credit score, character, past history and willingness to fix the problem. Again, not using the credit card. So I'm not, just so you know, I'm not reading ones that have come up multiple times, but I'm just looking to see if there's anything different.
That's great.
Okay.
That's certainly what I want to lift up, and then Barbara
has a rainy day. Yeah.
Oh, go for it.
I was going to say has a rainy day credit card.
Right.
Yeah.
I
that's
think
basically what we're seeing. Yeah.
Yeah. Perfect. Lifting up some of those pieces around the medical debt and how she is working to try and handle that medical debt, and how she's handling that credit card that we talked about that is there in her drawer. Barbara, what do you want to highlight about those things?
Well, I think that Chanel is, and actually reminds me of multiple clients that I've seen our clients work with and also worked with when I was a practitioner, that Chanel is your answer, the way that you, and a perfect example of how you get to character in that she had a history of repayment. She had an incident that interrupted her ability to do that. She's owned it, she's figured it out, and now she's pretty disciplined about how she's going about moving forward. And I think she's a great example of a lot of the clients that come to us. And what we want to see is both sides of that, and especially the second side where she's reestablished that pattern and is really realistic about how she's going to manage this over the long haul.
Great. What questions do folks have? Trish, do you want to call out, see if we've got, let's take let's say 2 questions right now so that we can keep moving.
So we have not had a lot of questions. I'm gonna ask a question myself that's come to my mind, but also invite folks. This is your opportunity to chat in quickly a question, since we don't have any others in the queue. If you have one that you want to pose to Barbara or Leslie, and Barbara, I just want to ask your or Leslie your opinion about this issue that you have, Barbara. This person who you're calling a later client or a not now client, and I just one other model I see of dealing with that kind of client is to make them a yes client, but to do that through a very small credit building loan, which basically says, I'm not willing to make you a larger loan for your business, but I may be willing to make you a $500 loan or a $300 loan, and see how you do with that, and use that as a way. So in other words, I'm going to give you a tool that you can use to demonstrate that consistent behavior. And my sense is there's lots of questions that an organization might want to ask itself before getting into that business of doing the credit builder loan. What are the costs involved, and maybe I need to take a little more risk on that part of my portfolio, and am I willing to do that? But I just wonder, does that sound consistent for you in some ways for what you're talking about here?
It totally does, Joyce, and I thank you so much for asking that question. So one of the things that is really important in our work is not to set our clients up for failure. This is why I feel so strongly that really using these 2 predictors of repayment for our micro borrowers helps mitigate their opportunity to fail because they can't take on this debt and be successful. The same is true around credit builder loans and financial literacy. We have to remember that some clients haven't had an experience of repaying debt. They literally don't have an experience of repaying debt. think about it in some ways as your child who you raise and they leave home and they get that first credit card, and they don't have any pattern of having to make those monthly payments. And so they need support in learning how to actually make sure that that happens. I really believe credit builder loans are super important in this ecosystem. We need to make sure that we don't start them with a credit builder loan if we haven't done a good job of assessing whether they need the first piece of skill, which is actually sitting down and figuring out how to manage their personal budget, what their cash flow at home is, and how to set up a system for being able to account for and make sure that they make those payments on time. So if they have that system in place, the second step is this credit builder loan. Sometimes we see the marrying of teaching them those skills and helping them learn to develop those skills in tandem with that credit builder loan. But I want to make sure that we don't just jump to a credit builder loan before we've really helped the client understand whether they have the skills they need to make payments even on the credit builder loan. Does that make sense?
Yes, and now we have a lot of questions.
And if, Joyce, can I just tag on to what Barbara said really quickly, and we'll take one more question, and maybe, Joyce, we could keep moving, is, having been a practitioner myself in trying to do credit builder loans at one point, I think one of the biggest lessons that I learned was I encourage people to think about credit builder loans as related but different products. Is another way to say this, that a credit builder loan is an important tool, and we've got some great practitioners in CDFIs that do great work there. Justin Peterson is one that comes immediately to mind. And they treat it as a different product with all of those pieces that Barbara just talked about, rather than, as Barbara said, as a default around, well, can't do a microloan, so let's just go straight to this. So we just encourage people to think about it as a different product, and to then therefore think about the kind of tools and the kind of both character and capacity requirements that they would need to mitigate their risk.
Okay. So just a little bit more on this. We had one question that says, isn't the model of a CDFI to pair lending with financial literacy, pairing credit building loans with budgeting and credit counseling? So I presume from what you said, your answer is yes, but maybe? Or yes
well,
and?
I would say the answer is yes. Writ large, it is part of the broader mission of the CDFI industry in supporting underserved populations. Not every CDFI chooses to actually have that as a piece of their specific mission, but we often see micro lenders and other small business CDFIs partnering with organizations in their community that may not even be lending organizations specifically or CDFIs that will do that, whose mission is that financial literacy. So for example, I know that in Detroit there's the there's an accounting organization that does nothing but work with people with financial literacy. And they're a great partner for the CDFIs in Detroit in helping support clients who need that first piece of financial literacy before coming back for their first small business or microloan.
Yeah, and I just maybe just another way to, yeah, the accounting society or your accounting aid society or something. Yes, yeah. One way I think to say that is that I think a lot of CDFIs do technical assistance or some kind of development services, but they don't necessarily specialize or have a lot of time to spend on in-depth sort of financial capability credit building work. And so sometimes they may need to develop that in order to do the credit building piece, and in some cases they may need to refer it out. We have another question. What is it that Chanel can do to become a Now client since she appears to be sticking to her payment plan?
I think the credit C piece is pretty there for Chanel. She has a history of repayment before her incident. She's demonstrated that after the incident she is back on track for repaying her debt. And now we have to decide whether she has the capacity to service a loan. So I don't think we're at not yet for Chanel.
Okay. So I'm going to what I'm going to do here is I see some questions, and folks, I'm just not going to answer them because they're starting to get us to the next part of the presentation. Let me ask one more question. I have a client. Here's one that says, I have a client whose credit score is low because of past missed credit card payments. The reason was due to financial hardships because she was unemployed to take care of her ill mother. What proof can we ask to verify, and can we accept this reasoning based on verbal explanation? So basically, she's told her why she's missed the payments. Do you need to verify that, or can you trust the client's word?
I think that's a broader question, and it's broader in the way that we look at the whole credit file and whether we have evidence, objective evidence that can cohere around the narrative that the client tells us. And unfortunately, we're not able to get into the weeds about this today. But part of our challenge when we're looking at this is to be able to cohere the narrative around some objective evidence that's broader.
Great. So there's just so folks know, because some of these are getting into some additional questions, or to what's going to come up next in the presentation since I've seen it. I'm going to go ahead and let Barbara keep moving on. Barbara, I'm going to go to the next slide. And then there are also some questions that I think maybe Leslie or I could just, or I know I can respond to some of them just directly via the chat. So as folks know, we have more than 200 folks on the line, so we may not get to every question, but we'll do our best. So Barbara?
Thanks, Joyce. Okay, so we have 2 predictors of repayment, 2 of the 5 Cs. One is that character C, and now we're going to talk about the capacity C. So the first thing we need to decide and be clear about is what is capacity. So Joyce, can we go to the next slide? So what Leslie and I would like to have you consider is that capacity, when we look at microlending and microloan underwriting, is a holistic concept of cash flow. So that holistic concept is the client's ability to pay their business expenses as well as their personal expenses with the existing business revenue and outside income. So let me say that again. Capacity, when we look at it as a holistic concept in establishing the capacity for underwriting microloans, is really that client's ability to pay their business bills and their personal bills out of the existing business income stream and their outside income. And I've been known to describe this as all income in and all expenses out for the whole household unit. So all income in, all expenses out for that household unit. We know that this can be calculated in different ways. It can be calculated as global debt service coverage, combined debt service, or UCA, Universal Credit Analysis. You may be familiar with one or all of those. So relative to today's conversation, what we really want to do is focus on global debt service coverage. Because while each of those has a slightly different approach to calculating it, to calculating capacity, we really believe that global debt service coverage is really the best way to get at their financial capacity. So when we look at global debt service coverage, we're really looking beyond cash flow of the business to the outside sources of income as well, and also outside expenses that are going to put pressure on that business's cash flow. And within that, we really need to figure out what role, if any, the projections from that business plan are going to play in our calculation of capacity. So let's start with our approach. Let's start with our approach to establishing that list of documents that we're going to use to build global debt service coverage analysis. So where do we find the information that we need to verify? And once we've found it, then we can look at how we're going to use it. So microlenders typically collect a plethora of information from our clients, and our clients tend to be frustrated at how much we ask them to give to us. But we ask them to give this information so that we can really get a holistic understanding of their business and really use that information to determine the risk that we're taking on. So within that list, there are really 4 key documents that we're going to use where we're going to find that information we need for this capacity analysis. So in my experience both as a practitioner and with our clients, I really have experienced that microlenders typically work with 3 of these. We ask them for tax returns, both the business tax return and the personal tax return. We pull a credit report, and we ask them to complete a personal financial statement. So let me take a moment and say that if you are an emerging micro lender and or you're using alternative sources of analysis, we really would like you to think about the fact that you need to pull that credit report. There is no substitute for that, really. It's a key piece of what we need to look at. The second is that oftentimes our clients struggle with completing an accurate personal financial statement. And what I'd like to encourage you to think about is think about that as opportunity as opposed to struggle. It's an opportunity for us to do some really robust pre-loan technical assistance with our clients. It may be the first time that that client actually begins to put on paper the fact that they have assets and the fact that they have liabilities, which means they have a net worth. And to be able to introduce those concepts to them about their financial situation and then to help them connect those dots. So this is really an opportunity for us to help them grow in their understanding of their own financial circumstances. Let's talk about that 4th document. So that 4th really important source of verification is bank statements, both the client's business bank statements, and depending on what we're struggling to verify, we're also wanting to verify their collect their personal banking statements. So, and additionally, at times we're even going to ask them to give us a pay stub from their outside employment. These are the documents that we're going to use to tie out the verification of their income and expenses for that household. As important as tying out those sources of information, tying out verification of their finances, they also are going to point out some gaps. And those gaps are going to become apparent, and it's going to help us to understand and question and challenge and figure out what the answer to those gaps are. And that question that was asked earlier is a little bit about that. So it falls into that category. Also, on this list, you'll notice that Leslie and I have included some asterisks next to certain documents. And we just need to do a footnote here. We do not consider bank statements a great source for verifying income, but they are a great window into the movement of cash for the borrower. And we know that financial statements aren't always accurate when they come to us, but they do help us understand how the borrower defines their expenses and their revenues and also their assets. So they're valuable and we need them. So that's the what of capacity. Now we've looked at where we find the documents that are going to help us with that. Let's now talk about how we analyze that capacity so that we get to our answer of whether they can afford to make a payment on our new loan. Okay, so the first tool we're going to use is we're going to use this business cash flow analysis. This is really intended to help us understand the liquidity of the business over time, and also is going to help us determine how much cash is available at the end of the day, if you will, to make that new loan payment. We don't have time today to go through this document, this tool in a granular way, but what I would like to point out to you is that really what we're coming down to in the bottom is that net debt service available to make that loan payment that we're about to give them. Also, I'd like to pause here for just a minute and talk about projections. So when we talk in the business cash flow analysis tool about business revenue, this is where if we're going to put projections, this is where we're going to put them. You'll notice on the tool we shared that we have the 2 prior years of cash flow, the current year, which I would encourage you to annualize when they give you the year-to-date information, to annualize that so you're comparing prior years and this year like all apples, if you will. And then we have the opportunity to do some projections moving forward for 2 years. When it comes to projections, when we're calculating the capacity of an existing business poised for growth, those growth projections that you find in their business plan should not be included in your out-year business revenues to evaluate their ability to pay that loan. Let me repeat. The growth projections from their business plan should not be put into this sheet to be included in the business revenues to evaluate whether they can afford that debt. And here's why. The business needs to be able to demonstrate that they can support that added debt whether they grow their revenues or not, whether the growth strategies that they're working on and implementing, that often that capital that we're going to give them is going to seed, whether that works or not, we need to know that we're going to get paid. So we don't include those projections of revenues in the out years. Okay. When we work with startup businesses, how do we handle projections with startup businesses? What happens is we don't give any projections for revenue in that startup business for 2 years. So regardless of what the business plan says, we're not going to give any value to the business's revenue of that startup for the first 2 years. In addition to that, when you look at a startup business and you're trying to figure out their debt service available, what we want to make sure is we include any debt that that business is going to take on, any expenses and debt they're going to take on as they start their business, that if the business doesn't make it, they're still going to be required to pay. So those are typically what we're going to see there is we're going to see their lease payment, the utilities for the lease payment, and your loan payment and any other loan payment that they've taken out on behalf of the business to start it. So we're not going to give them any value for the sales revenues on that startup business for 2 years, but we're going to take into account the money that they're going to have to pay if the business doesn't make it. Yes, there are exceptions to these rules. Really, there are exceptions to these rules, but it's really important that we start with that baseline of how we retreat those projections because we're really trying to look at the baseline of our ability to be repaid. So now we know what the business can afford to contribute to making a payment on our new loan. Let's look at the global debt service coverage next. Thanks, Joyce. So now that we know what the business can afford, which is the top line, we also know what the business debt is because we've used the documents that we have for verification to understand what the current business debt is. We also know what their personal debt is. And as we complete this global debt service calculation, what we can finally get to is the global debt service coverage ratio. And that's the bottom arrow. So what we really want to figure out in that holistic concept of cash flow of business and personal expenses and income, what we really want to do is to get to the point where we know what that global debt service coverage is. Okay. In the end, what we want to have is a 1.25 to 1 global debt service coverage in order to move forward on the capacity. I'm going to say it again. What we really want is a minimum of a 1.25 to 1 global debt service ratio in order to move forward in extending that credit. So what happens if we don't have 1.25 to 1? This happens in our world a lot. So how do we improve global debt service coverage so that we can get to a yes on this? Joyce, do you want to turn the slide? Thank you. Okay. Typically, we have 3 best practices for this, everybody. The first is we're going to reduce the size of the loan. We need to bring the size of the loan down so that it meets that global debt service coverage capacity of our borrower. We do this all the time because we know that our businesses are fundamentally in microfinance bootstrapped, almost always. So we usually can find a way to bring the loan down to meet that global debt service coverage and still give that borrower the first piece of what they need to launch their business or to start that growth plan. So let's look at Chanel, for example. So Chanel really wanted a new van. But when we showed her the global debt service coverage and we worked through it with her, it became very apparent that she doesn't have enough money every month to pay for that van. She needs to use, but she can't afford to get a late model used van. And so she's good with that. She's going to buy the late model used van, scale back her expectations on that shiny new van. The second strategy we're going to use, and we use all the time in our industry, is to do step-up loans. And what we want to see is that we bring that global debt service coverage ratio into line with the first loan we give them. And then once we have a history of Chanel paying as agreed, and also we can see the actual financial performance of her business, we can entertain a second loan or a third loan and probably a larger loan. But we need to see that evidence of repayment and also see the actual business revenue generation. And of course, the last strategy we use is that we ask that client to go find a guarantor who can bring some extra financial strength to increase that global debt service coverage. They can bring a guarantor to guarantee part of that loan or all of that loan. And this is a really common strategy when we have a client who has a really good repayment history. So their character C is really strong, but they're really short on their global debt service coverage. And just a reminder, with those clients, it's really important when you bring a guarantor in that you use the same due diligence process with them around verifying their character and their capacity that you use with your client. So just a quick review of this capacity C. We really want to be clear about what capacity is. It's that holistic concept of cash flow. And we want to make sure that we know how to calculate it so that we know whether they can make those payments. This is the framework we want to recommend to you so that you can have that systematic, transparent, and evidence-based calculation of capacity that Leslie's been talking about. Leslie?
Great. So I'm going to say just a few quick words about the other C's because you all may be wondering, where's the love for capital, conditions, and collateral. And lest you think we have forgotten about them, we have not. Here's what Barbara and I'd like to say about the other C's. And Joyce, if you want to go to the next slide, is this. We would say about the C's what we said about projections. They are context. They are not as much content, though, from a microloan underwriting perspective. They are less influential for borrowers in their ability to repay a microloan than these two big C's are that Barbara has taken us through. Microfinance repayment is really about that, again, as Barbara said, household's ability to repay the debt. And we also know, team, because we've all looked at these files, there's a lot of commingling of the personal and business finances. And so microloans are of a size where really drilling down into those two C's are where you are going to identify the predictors of repayment. Understanding the business's capital structure, for instance, digging into the industry trends, understanding their collateral, again, helpful, and they are context. But these are not going to be the primary drivers of repayment the way those two first C's are. And I'll just end with this. One of the wonderful people who trained me in this industry is a woman named Fran Dever, and she was an old school in all the best ways collector. And she used to tell me often, Leslie, I have never seen a truck drive into my office and pay me my loan back. So I know that we all in microfinance tend to sometimes get big eyes around great collateral if there is any to be had. Just a reminder, it's the collateral that doesn't, in microlending, often pay the loan back. So with that, Joyce, any reflections you have from field research and anything we've heard and any key questions that you think we need to get to in these last few minutes with folks?
Yeah, I'm going to go ahead and read a couple more questions since some more questions have come in. And one is, why aren't you giving them any credit for projected revenue? Is there a model for using a percentage of that revenue?
Barbara, do you want to take that, or do you want?
Sure. Sorry. I'm sorry. Yes, I would love to take that. There are times when you can use projected revenue, and let me give you an example. When you're lending somebody money to buy a transport truck, and you know that when that transport truck hits the road, they're immediately going to generate some revenue. You can give some value to projections because the money you're giving them has a direct correlation to some level of sales revenue. You just have to be really cognizant of the fact that you don't want to overstate that. So that is one narrow example of why you can do that. Remember at the end I said there are exceptions, but generally speaking we would rather have you start with the really undervaluing those projections as opposed to overvaluing them. Joyce?
Yeah. So we have a couple questions for the group about whether we can provide copies of the business of the spreadsheets around cash flow and global debt service coverage, or whether folks can use some of the PowerPoint slides for their workshops. So I just want to let folks know we've seen those. Let me talk to Barbara and Leslie around those, and I just want to make sure that there aren't any sort of copyright or ownership issues there before we say absolutely yes, that we can provide them in that format to folks. But I just want to acknowledge that we've seen that question, and if we can provide them, we will. Just looking to see what else we have. Oh, here's a great question. Are there specific ways we can keep implicit bias in terms of race and economic status from entering into our evaluations of character as lenders?
This is Leslie. I would love to start. Barbara. Oh, sorry, go ahead.
Please do. Nope,
okay.
Please do.
Really, really appreciate that question. And here's why we appreciate that question. It goes to those 4 words that we used at the very beginning of our time with you today. This notion of building underwriting so that it is systematic, evidence-based, transparent, and also monitored. That is a question that for us really speaks to the heart of why we think those are the critical components of building a robust underwriting framework, so that candidly, guys, we steer away from those moments and circumstances within our underwriting teams where there's a wink, wink, nod, nod around which underwriter should I shop this loan to today, or I wonder if my underwriter's in a good mood this morning, so that we can move away from some of those what might be subconscious or internal biases. It's also why we encourage, from a credit report perspective, a comprehensive and holistic look at the credit report. We understand that there is, from a credit system perspective and a credit score perspective, some inherent structural biases around various communities and what we know about credit scores there. This is where I really also want to highlight this notion of transparency and monitoring of the outcomes and results of your underwriting standards. Because it is in monitoring the outcomes of the decision-making process that you can yourself hold your own feet to the proverbial fire around who it is you're lending to and the kind of outcomes that those borrowers are experiencing from your process. The more transparent that is internally, the more effective your loan officers will be able to communicate to each other and reinforce those transparent, evidence-based, systematic standards, and the better they're going to be able to communicate those to our borrower communities who deserve that kind of information to overcome some of these more structural and systematic barriers that they face in the larger financial market. Barbara, what would you add to that?
I would add that this is the client's financial information. And one of the missions we have in our life as our work that we do together is to help our clients grow their business acumen. So just thinking through this, there isn't anything about our analysis of their financial information that wouldn't be able to be transparent to them. And I think that transparency and that information is powerful. It's educational to them. It allows us to join with them and to have a common place to start with the work we need to do if they are a not yet. So I don't see any downside to it, and there's just every upside to it.
Great. So Barbara, I'm going to jump in here just because we did have a question, which was how transparent should one be with a client in terms of going over what the underwriter is taking into consideration? It sounds like you say highly transparent because part of what you're trying to do is help them understand. Okay, great.
Yep.
Can I just also add terrific. I'm just going to add one other piece to that, the answer to that question, which is just from some research we did, and we actually published a paper earlier this year called Bridging the Divide, and it looks at the connection between business ownership and the racial wealth gap. And one of the things that we found is that generally speaking, one of the reasons why particularly businesses owned by African Americans and Latinos face large challenges in growing their business is their difficulties in accessing capital, and those have largely to do with issues of credit and issues of wealth and collateral. And so what is important about this approach to underwriting is that it addresses those questions in a couple of ways, because it says basically, when they say credit, they're saying credit score. And what we're saying here is that we're looking at character and looking at around the ability to meet financial obligations, which individuals who may not have a good credit score for a variety of either individual or systemic reasons may be able to get around if you look more broadly at that issue of that definition of character that Barbara and Leslie have shared. And the second piece is just because if someone's able to show in the capacity to repay, the fact that they don't have a certain amount of capital or a certain amount of collateral may not rule them out for that credit. So in some ways, this is an approach to underwriting that explicitly addresses some of the most important barriers. And then as Leslie says, the other potential piece, then the issue that people have in the market is this issue of discrimination, which can be a really complex thing, but gets away from that sort of, wow, I really like this person and whatever can be embedded in that, or I can communicate with this person, to get to a really set of objective and transparent factors that you can look across barriers and monitor in a way that allows you to address that. So I think it's a really powerful tool for addressing those issues. So I'm just looking at time here, and we have a few more slides to get to, and we're running a little bit late. I realize we started late. So if that's okay, and I don't see a ton of questions we haven't gotten to. Leslie, did you want to say one more thing to close out, and then I'll move us into a final few slides about more information?
Thanks. I just say I hope that we've been able to accomplish today what we said we wanted you to walk away with, and that is either a new idea to share with your team, maybe a new way to look at an old idea that helps you meet your mission, or maybe even an idea for a topic you and your team want to discuss. So we thank you all so very much for the chance to do this work, and we thank you so much for helping Barbara and I learn so much over our years in this industry, and thank you, Joyce, for the opportunity.
Oh, you're welcome. Thanks to both of you. So I'm going to go through some slides. Please hang on for a few more minutes. These are important. First of all, just in terms of learning more around this issue, I just want to remind folks you already have the slides for today, and we will post the recording as soon as we make sure we have a clean one for you all to be able to listen to. As Leslie alluded to, we're going to be hosting another webinar on that more sort of holistic approach to overall portfolio management on October 26th. In the slides, there's a link that you can use to register now, and we will be promoting that way in the way we have before, and we will do our best to not repeat some of the technical issues we had this time. The other thing that Leslie mentioned is that for those of you who are attending the OFN annual conference, we are actually, Field is involved with some other organizations that we work with through our Microfinance Impact Collaborative. We're doing a session on strategies for driving scale and impact and micro and small business lending. We're going to explicitly talk about how organizations are applying some of these concepts today to ideas about how to get quickly to yes for folks, how to streamline their lending, so how they're applying their practices to develop new products and to serve more customers. So that's one piece. The other thing I just wanted to talk about a little bit was just to make our plea to please, if you found value in this session, to please respond to our U.S. Microenterprise Census. Many of you were aware, I mentioned at the beginning of this, that we collect data on the field each year as part of our Microenterprise Census. It's certainly the only annual source of data out there on the U.S. microenterprise field. This slide shows the kinds of data that we're able to generate from through organizations contributing their data. It's the only place that we know of where we can, if funders come to us, if policymakers come, if members of the media want to know what micro enterprise look like in the U.S., what they can expect from investing in it, we're the only place we know that they can find that kind of data. But we only have it if you report it to us, and the more folks that report, the more robust that data is. So we ask again, if you found value in this, to please give back maybe by reporting your data to the census. For those of you who have reported to the census in the past, I just want to let you know, first of all, we know it takes time, and time is one of your most scarce resources, so we've thought a lot about how to make this easier and faster. We have an online survey you can use to report data. We've streamlined it a lot over the years, so if you haven't taken it in a couple of years, hopefully it's a lot easier. We've made it more customer friendly. It's on our newly rebuilt website, which means the functionality is better. If you've responded to the census before, some of the data will actually pre-populate for you as you enter your organization's name. Some questions will disappear if they're not relevant once you tell us what kinds of work you do. So we really are trying to make the experience better. Again, if you could respond to the census, we'd appreciate it. The way to do it is to go to our microtracker.org census to this link, and that'll take you to a page that allows you to report data. So if you do have questions as you try to go in and respond to the census, you can email Lavi Mohan on our team. We're happy to help give you support on how to do that, and I'll show you her email address as well as Barbara and Leslie's in a minute. But again, it really is a way that you can help and the field together can work together to provide data that you can find useful as you try to build your organization and understand how you compare to other organizations, but that we can also use to educate those who make key decisions about the level of resources that are available to support our work out there. So with that, again, we do have for those questions that we didn't get to, we do have a record of that. We may be able to follow up with some of you by email. You can also reach out directly to Barbara and Leslie, and their email address is here, as well as the email address of Lavanya Mohan on our team who can help you with the census. So thanks again to everyone for being part of the conversation today. We hope this has been useful to you, and we look forward to having you join us again in October. Thanks, everyone.